Former bank executive warning that when Discover Financial catches a cold, the rest of the industry gets the flu. Nigel Morris is Capital One's co-founder and former chief operating officer. He's now managing partner in fintech VC firm QED Investors. Nigel, welcome to Fast Money. So you know this space intimately, and I'm curious, how do you read this? Because there is some thought that perhaps Discover Financial reached too much in the pandemic for growth, so they extended their credit cards too much to too many people, and it's just sort of digesting that now, or is it a real sign of deterioration in the consumer?
Thanks for having me. It might actually be a bit of both. I think that it's very easy to lose sight of the fact that the credit card business is often the crown jewel in retail financial services. Capital One was built on doing credit cards really well. And, the returns on equity can be 25, 30% if done well. So there's always a lot of incentive for banks and monolines to do more of it. And look, we were talking about $1 trillion now of credit card debt and $175 billion added since the fourth quarter of 21. So a lot of growth. If we look at Discover in particular, the charge-offs are in the normal range, around 3.5%, 4%. But it was the pace at which the charge-offs went up that would draw your eye to be concerned. Delinquency went up too, and a whole host of compliance issues that were pointed to in the earnings call last night. So as I take a step back and look at the health of the consumer, as you rightly pointed, and what that means for charge-offs, on the positive side is that unemployment is 3.8%. And the fact that people have jobs means that they can pay back their debt, all things being equal. And the fact that the large credit card issuers have pulled back in the last 6, 9, 12 months and have tightened their credit criteria. That bodes well. Now, on the other side of the equation, there's a few things to watch out for. Firstly, that student debt is kicking in this month. So what is it, 40 million Americans, $1.7 trillion, and the average person is going to have to, of the 40 million people who owe, is going to have to come up with $350 this month. That's a decent-sized number. That will hurt. The fact that the growth rate is slowing, which means the denominator goes down, which all things being equal, the percentage will go up. And the savings rates drop dramatically. I mean, Americans were saving at 26% at the time of the height of the stimulus, and at 7 or 8% before COVID hit. Now we're down to 4%. So, but the point about spending, it's been incredibly robust. But my take is it can't go on for much longer. So net-net, I think that we're going to see a bubble of charge-offs flowing through the system. And the big question is what happens to unemployment 6, 9, 12 months from now? Right,
when that bubble theoretically pops or is stretched to that limit. I'm wondering, because, fintech is amazing. It can be amazing. And I'm wondering if it's operating in the same not good environment where the consumer is stretched, the consumer is challenged, et cetera. It's operating in the same macro environment that all the other traditional financials operate. So what can fintech do better in this environment?
Well, look, certainly consumers and small businesses are suffering. There's no doubt that they are in this inflationary environment. They're dealing with enormous uncertainty, unprecedented uncertainty. The leverage that fintech brings to the table is it starts with a blank sheet of paper, largely digital, leveraging off new data sets, being really transparent with the consumer and looking to solve a consumer's problem rather than, be part of a large machine. The banks are really pretty solid and, by and large, very well run. But innovation is really tough. If you're not growing your revenue and you can't attract world-class talent, it's really hard to be a Klarna or to be a Credit Karma or to be a Stripe or a Square, companies that are fintechs that have now reached escape velocity. So for fintechs, the opportunity is really to offer services to people that the banks don't offer services to well, or candidly, the banks don't care to offer services to. And, half of America has trouble getting a credit card. Many banks don't really want to serve people with a FICO score under 650 because largely they don't have much money. And if you don't have much money and you don't want to lend them money, really, how do you make money from them? So this has been this is where the Chimes and the Currents and the Alberts, and the Mission Lanes have been able to step into that space. So I think fintech is doing a terrific job. If you look at the net promoter scores of the fintechs, the 70s and 80s, the banks are in the teens. So they really are solving a problem. That doesn't mean they can't do more, and there's more opportunity. But fintech is really there.